So the stock market's been on this incredible run lately, but suddenly it's hit a roadblock. It's like the music just stopped. And the real story, the reason why, isn't what you're seeing in the headlines. Nope. It's this hidden power struggle that's brewing between two of tech's absolute biggest players. Let's dig in.
All right, so let's start with the big question. Why the sudden pause? Why is everybody holding their breath? It's definitely more than just the day-to-day news. The market is actually waiting for a very, very specific signal before it decides to make its next big move.
To really get it, let's zoom out and look at the big picture first. You can almost feel it in the air, right? This sense of uncertainty that is pretty much everyone in a holding pattern.
There are some serious external pressures messing with the market's mood. You've got rising geopolitical tensions, these conflicting reports about diplomatic talks, and a really critical truce deadline that's coming up fast. And the result? Well, trading volumes have just tanked. The big money has stepped to the sidelines.
So the key takeaway here is pretty simple. This isn't about a lack of interest. This is a calculated pause. All the big institutional investors are just sitting on their hands, waiting for a clear, definitive green light. Okay, so now let's pop the hood on this recent rally. Because while the major indices looked great on the surface, when you look a little closer, you start to see that the whole thing was built on a surprisingly narrow and maybe even fragile foundation.
And check this out. This data tells a huge part of the story. The entire market rebound we've seen since late March, it wasn't some broad, healthy recovery. Get this, about 70% of the entire move up was driven by just two sectors: information technology and communications. That's it.
This right here illustrates the point perfectly. You look at the standard S&P 500, the one that's dominated by all the mega-cap giants, and it's flying high, way above its old peak. But then you look at the equal weight version, where every company has the same say. That one is only just now catching up. That tells you everything. It's the giants doing all the heavy lifting, not the average stock. And the numbers just confirm it. Out of 500 stocks in the index, only 126, that's barely a quarter of them, are actually trading anywhere near their yearly highs. This really hammers home just how concentrated, how narrow this whole advance has been.
Now for the really juicy part. Let's see what the so-called smart money, the hedge funds, are up to. Their positioning tells a story that isn't just about everyone being super bullish. It's a bit more complicated than that.
You see, a huge chunk of that recent buying didn't come from new investors piling in, betting the market was going to the moon. A lot of it was actually fueled by a massive short squeeze. You had all these people betting against the market who got caught and were forced to buy back shares, which, of course, just pushed prices even higher. At first glance, it looks like these funds are all in. If you look at their gross leverage, think of that as just the total amount of money they have in the game, both long and short, they are way up there. We're talking the 98th percentile over the last 5 years. That is an extremely high level of exposure.
But, and this is a huge but, here's the twist. If gross leverage is the total amount of chips on the table, net leverage is how much you're actually betting the market will go up. And that number? It's shockingly low. Just the 21st percentile. It shows that while these funds are heavily involved, they have very, very little conviction that the market is going to keep ripping higher from here.
So all of this brings us to the potential tipping point. The real catalyst that could break this market stalemate might not be some big headline, but an internal fight between two of tech's biggest titans, software and semiconductors. And because these two have been driving almost the entire market, a shift between them could send massive ripple effects everywhere.
So for a while now, one of the most crowded, most popular trades on Wall Street has been this classic pair trade. You go long on the high-flying semiconductor stocks, and you short the underperforming software stocks. Easy, right?
But this sets up a really critical question. What happens when literally everyone is leaning the same way, and the losing side of that super crowded trade, in this case software, suddenly wakes up and starts to break out? Well, it could trigger a powerful chain reaction, a cascade. First, the software ETF breaks through a key technical level. That forces all the short sellers to panic and rush to buy back their shares, which just fuels the fire. Now, where do they get the money for that? They sell their winners, the crowded semiconductor stocks. And just like that, boom, market leadership could flip on a dime. So here's the bottom line. While the rest of the world is waiting on macro news, the most immediate trigger for the market might be this internal tug of war. And luckily for us, there are specific price levels we can watch that will tell us if this big rotation is actually starting to happen. So get your charts out, because these are the numbers you need to watch. For software, the big one is the IGV ETF breaking out above $88.60. That's the trigger. If that happens, you'll want to keep an eye on the semiconductor ETFs, SOXX and SMH, to see if they pull back toward their major support zones. This isn't a prediction, of course, but it's a roadmap for how this capital rotation could play out.
And that leaves us with the million-dollar question that could define the market's next big chapter. Is the incredible, unbelievable party in semiconductors about to get crashed by the revenge of software? The answer to that is probably going to set the tone for the market for weeks, if not months to come.